Ladies and gentlemen, good day and welcome to the Linc Limited Q3FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions post the management's opening remarks. Should you need assistance during the conference, please signal an operator by pressing star then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Naveen Agrawal, Head Institutional Equities at SKP Securities Limited. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. It's my pleasure to welcome you to this earnings conference call on behalf of Linc Limited and SKP Securities. We have with us Mr. Deepak Jalan, Managing Director, Mr. N.K. Dujari, Director of Finance, and Sanjeev Sancheti, Juritus Advisors LLP, the IR advisors to the management. We'll have the opening remarks from Mr. Deepak Jalan, followed by a Q&A session. Thank you, and over to you, Deepakji.
Hi, good afternoon, and a very warm welcome once again to Linc Limited's Q3 FY23 earnings conference call. I will take you through the business and operational highlights of the quarter gone by, while our Director of Finance, Mr. Dujari, will share the financial metrics. I'm excited to share that Q3 FY23 witnessed another back-to-back strong performance, with the company reporting its highest ever profit with improved margins. Pentonic sales continue to grow, with its share crossing the 30% mark. Linc revenue also posted strong growth. Further, export revenues continued its growth trajectory too. Hence, our operating revenue grew by over 30% YOY at rupees 124 crores. With Pentonic sales contribution continuing to grow and with plans of introducing new products in the Pentonic stable, we expect strong top-line growth in the coming quarters as well. In the writing instruments segment, the company continues to have a strong presence with a market share of about 8%, and company's focus on rupees 10 plus segment of the market since the launch of Pentonic brand has helped the company grow at a faster pace. One of the USPs of the product, its perceived value due to its unique design, has gone a long way in establishing Pentonic as one of the strongest brands in its segment. In over 3 years, Pentonic now contributes over 30% of company's core revenue, as against less than 7% in FY19 when it was launched. Due to higher GPM of over 40% in Pentonic series, the company's average GPM, which was below 22% in FY18, has crossed 33% in Q3 FY23. Better product mix, along with steady raw material prices, has resulted in sharp increase in operating margins. Export contribution increased to 23% as against 20% in the same quarter of the previous year. Operating EBITDA margin also increased sharply to 14.6% in the quarter as compared to 12.3% in Q2 of the same year and 7% in Q3 FY22. Of late, polymer prices have been on a slight uptrend, which we intend to offset by improving the product mix. With this, we expect to maintain our profitability. Linc 2.0, which we've been discussing, for last 2-3 conference calls, the 5-pronged strategy embarked upon by the company in the last quarter of FY22 has started bearing fruit and company has been able to achieve highest ever profit and significantly improved margins over the last 2 quarters. We continue to focus on our core strengths and the laid down strategy, and we believe the company will not only grow rapidly over the next few years, but will also be able to expand its margins with judicious product mix and economies of scale. The strategies adopted by the company are once again listed below. The first is increased touch points. India has over 10 million non-stationary outlets, as you may be knowing, kiranas, medical stores, farm stores, etc. And from nowhere in FY20, the company has reached to almost 1.4 lakh such outlets directly, thus taking its total touch points to over 2.4 lakh outlets. The company expects to expand its overall reach to more than 5 lakh touch points by FY25. The next point is the focus on higher margin products. We continue our focus on higher value and higher margin products. Quite a few products are under development in Pentonic portfolio, and one of them, priced at rupees 40, is finally likely to be launched in this quarter. Inroads into stationery products. Company's foray into full range of stationery products through an exclusive tie-up with Delhi is progressing well, and we expect to generate a minimum of rupees 100 crores of revenue in 3 to 4 years' time. In fact, we've already done a top line of rupees 18.5 crores in the first 9 months, and we expect to close the year anything between 25 to 30 crores. Step up of the existing capacity. To meet the targeted demand, we are planning to increase our manufacturing capacity at Gujarat by putting up an additional manufacturing facility adjacent to our existing factory, which was also mentioned in my earlier conference call. ESG, on ESG front, the company has taken the following initiatives. Number one is substituting plastic wrappers with bulk packing in paper boxes. This initiative saved about 60 tons of plastic in FY22, as mentioned earlier also. We employ more than 1,200 female workers in our manufacturing facilities. We also employ and provide training to a small number of specially abled workforce. We support several NGOs who provide education to the less privileged sections of the society. The company is actively working on projects like recycling used pens. Consumers are encouraged to change the refill rather than buying a new pen under its Refill More campaign. These efforts will go a long way in contributing towards reducing the carbon footprint of our planet. Now I would like to hand over the call to Mr. Dujari to provide updates on financial numbers. Thank you.
Thank you, Mr. Jalan. Good afternoon, ladies and gentlemen. Many thanks for joining the Q3FY23 Linc Limited earnings Concall. I will give a brief overview of the financial numbers for the quarter before we open for Q&A. During Q3 FY23, the company's operating revenue grew by over 30% from rupees 95 crores in Q3 FY22 to 124 crores. With improved product mix, increase in selling price of its legacy products, rationalization of input prices and strengthening of USD, the company achieved record profit in the current period, with operating profit margin crossing 33% in Q3 FY23. Q3 FY23 PAT stood at 11.1 crore, up from 2.8 crore in the same quarter of the previous year. Q3 FY23 EPS stood at 7.48 versus rupees 1.87 in the same quarter last year. Same period last year. Company continues to use its free cash flow judiciously, and in the process has been able to reduce its net debt significantly over last 4 years. From a net debt of rupees 62 crores in FY19, the company is now debt-free with a free cash flow of over rupees 16 crores as on 31st December 2022. As informed, the company has embarked upon a modular expansion plan in Gujarat next to its existing plant. With the basic infrastructure is being created to double its capacity to 20 lakh pens per day. Some of the critical equipment machinery will be added in modular fashion in sync with the demand needs. The total cost of the project is expected to be rupees 50 crore. The first phase of the expansion, which will increase the capacity by 5 lakh pens per day, will cost only rupees 35 crore and will be operational by Q4 FY24. The expansion will be largely funded by internal accruals. On the back of strong demands for company's products, better product mix and improved margin, the company is revising its guidance upward to achieve top line of over 700 crore by FY25 with a CAGR of over 25%. During this period, the share of Pentonic revenue is expected to grow to over 35%, while Delhi is expected to contribute over 10%. We expect to achieve an annual operating EBITDA margin of over 14% by FY25. With low-cost modular expansion and judicious use of debt, we also expect ROE to be above 21% by FY25. We continue to remain focused on our long-term goal of sustainable growth, profitability, and a strong deleveraged balance sheet. With this, I leave the floor open for Q&A. Thank you.
Thank you, Naveen. Thank you, everybody, for joining this call. If you have any more questions, please do reach out to Mr. Dewari, but I'm handing over now to Naveen to open it for Q&A.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If your questions have been answered and you wish to withdraw yourself from the queue, you may enter star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, you may enter star and 1. We have the first question from the line of Dhaval Shah from Girik Capital. Please go ahead.
Yeah, hello. Yeah, hello. Yeah, congratulations, great numbers. And I must say, great distribution and the product basically is fantastic in the on the ground. Sir, over the next 2-3 years, on the guidance which you shared, if you can help us understand what sort of advertising budget or advertising spends are we planning to do, and also with the expanding the distribution reach, how do you see the competition also shaping up after seeing success of your brand? These are my 2 questions.
All right, Dhaval, right?
Yes, Dhaval. Yeah.
So, of course, so far advertisement budget is concerned, we have earmarked about 3% of our sales to go towards the advertisement, whether it is ATL or BTL. While I would say that, as you know, or we call it, writing instrument is a low involvement category. So, and of course, we cannot expect to create a brand pull from this spend, but this spend is mainly towards the hygiene, just to keep the, top of the mind recall for the brand, so that, when the customer goes to the point of purchase or point of sale, he can, Linc or Pentonic is, under his consideration. So that is the purpose we are trying to meet with the ad spend. And of course, you would see that the brand is quite visible in different media. So this is about the advertisement. But secondly, for any FMCG product, The most important is the distribution, which you mentioned, and we, as I mentioned in my brief, that we continue to expand our reach, and so that is the only way to increase our revenues, rapidly. So as rapidly as we expand our reach, the revenues will grow, as much.
Correct.
So, and of course, competition can also increase their reach. But India is such a large market that there is a room for at least 3-4 players. So, and we like to be always the first mover. So we will always carry this first mover advantage.
Sure. So what I meant by distribution is like, Hauser, I see, equally well placed, in the stationery shops or any other outlets where you get Pentonic. For example, the way I see, Pentonic box and Hauser box kept, next to each other in Mumbai, the same way I saw it in a small village in Gujarat. Okay. So even, Hauser is equally aggressive. So in terms of product basket, is the competition also following us the same way, or how would it be in terms of our offering to the market? Like 10, I think they are also like same way, 10 to 15 rupees bracket. Yeah.
Yes. So fortunately, the competition is following us. So why I say fortunately, because so long they keep following us, so generally it is seen that if you follow the competition, the success rate is low. So in the past, many of the existing brands, they have tried to copy Pentonic, but most of them have been unsuccessful. And lately, 2 brands have been, reasonably successful, and one of them is Hauser, definitely. But as I said that, we have several products in pipeline, and so all the products which are launched under Pentonic would definitely be, much better than any competition product. And I know that, all of those products would also be copied, but by that time, we will have some help.
Yeah, sure. And so my second part of the question is about the new product you mentioned about Delhi, under Delhi brand. So, what will be the category of products? Will it be the crayons and the compass box? And so what it will be? What other products will we be getting?
So under Delhi mainly, although they have a wide range of stationery products and several categories, including what you also mentioned, but currently our focus is on categories like calculators. Yeah. So currently in calculators there is only one international brand, Casio, which is very popular, and there is no second brand in the market. So we are trying to take that position of being the close number 2 brand. So that is our main focus. Apart from that, Caesars is another category where we are focusing. So Caesars is, of course, it is quite a gray area because it falls into stationery also, it falls into outside stationery. So this is one large range which we are, we have introduced in the under Delhi brand, and there are several other stationery products.
I understand. Yeah, great, sir. And also it mentioned about a lot of filing products, but
yes,
not
there are several files, PP files and folders, and regular files. Then there are correction tapes or double side tapes, desk organizers, pen stands. So they have a large range. So we are choosing categories, which we can do better job.
Sure. Okay. But just last thing, sorry. Also think you're getting into crayons because in that segment was a lot heated up with this new player, I think Domos, something like that. Dom. Yes. So
Yes.
he's given a top 5 to Camlin. Yeah.
Yes. So, right now we do not have any plan to launch crayons under Delhi brand because that will not be very competitive. So we have plans to, introduce such, products in, coming future. I mean, not immediate future, but yes, we have our eyes on such products.
Okay. Great, sir. Great. Thank you very much. I wish you all the luck. Thank you.
Thank you so much. Yeah.
Thank you. We have the next question from the line of Himanshu Upadhyay from O3 Capital. Please go ahead.
Yeah, good afternoon, and congratulations on great set of results. Am I audible?
Yeah, sure. Yes.
Yeah. So my question is, taking from the previous participant only, our touch points have increased quite dramatically, okay? And even if we take out kirana, medical stores and pawn stores, okay, the stationery, which has been the main bread and butter business for us, has also increased quite. What is our penetration? Let's say stationery would be around 1 lakh stores, okay, where we would be present, okay. In terms of our product presence, so Delhi and all these Pantonic and Linc and those products, how present are we with our traditional product? And in terms of Delhi also, what is the level of penetration and how soon can we increase that penetration? Because I think initial products what you are trying to do are 5 and 10 rupee products at the kirana stores, okay, or 10 rupee and 15 rupee.
Yeah, actually 10 rupee products.
Yeah, 10 rupee product. Okay. So now we want to get more out of those players. Okay. So what are we doing to increase the throughput per store?
Yes. So one is that when we launched Pantonic, it was launched in a 50-piece display. So we were able to sell 50 pens at a time to a retailer. But today we have developed, not today, I mean, of course, several months back, we have also developed a 100 pen display. So now our team is trying to promote that 100 pen display, so to increase the depth at the retailer point. So we are migrating from 50 to 100, So of course there are some retailers who still buy 50s, but many retailers we've been able to convert to a 100 pen display. So this is how we are trying to increase our, penetration into the retail outlets. Apart from that, the availability of our, Linc and Pantonic pens, I would say, out of the total universe of 240,000 outlets which we enrolled or sold, even once, about 80,000 outlets we are billing like every month. So many outlets are billed, every 2 months or 3 months, but on a regular basis we are billing to 80,000 outlets. So for Delhi is concerned, the penetration is still very low. We are currently doing in less than 15,000 outlets. So this reach is penetration is going to increase, every week.
So let us say in FY20, we did around 400 crores of sales, okay, and we had 65,000 stores or touch points, okay.
400 crores, out of which almost 80 crores was export.
Yeah, so 320 crores and 65,000, okay. So nearly 40,000 was per store we were getting, okay. We have 240,000, okay. Can we achieve in next 2 to 3 years similar turnover on these 240,000 stores, or do you think because the kiranas, medical stores and pawn stores are a bigger proportion, the throughput per store for us would be lesser and
Yes, absolutely right. Yeah. So exactly, just by multiplying the number of outlets, we cannot multiply in the same ratio, our revenue. So the revenue per outlet would be much lesser because typically a stationary outlet can even buy goods worth 25,000 rupees. I mean, not all, but some of them. Whereas a kirana or a general store or a pawn store, typically, these outlets, yes, they would not buy goods worth. Their purchase would be, anything between 500 to 1500 rupees, every month, and that too not every month. So yeah, so this difference would be there. So, but definitely, by increasing the number of touch points, we'll be able to achieve our, targeted, CAGR of about 20 to 25%.
okay. And two small things. Okay. So this 65,000 stationary points, which are currently around 1 lakh. Okay. How much time, or you think, can they achieve the traditional target of 45,000 for us? Means what we were billing. How much time will it take for these stores? Okay.
Sorry, I couldn't get your question.
So the 65,000 was the stationary shops in FY20. Okay.
Okay. Yeah. Mm-hmm.
And which is currently around 1 lakh stores. Okay.
Yes.
And how much time will it take, or where are we in the sales per store? Okay. For our main channel. Okay. Are we 70-80% of what we were in FY20, or it will take a lot of time to reach back? Okay.
I'm still not clear about the question, but
So I am saying that the stationary stores, we had 65,000 stores which used to do 320 crores of sales. Okay. Today we have 1 lakh stores.
okay, including the wholesale contribution, yes.
Yeah, and I am saying today we have 1 lakh stationary stores, and so can these 1 lakh stationary stores get me around 40,000 rupees per year in next 1 or 2 years? 40 to 50,000?
Difficult to say that, and I'm actually not prepared for such micro, details. But as I said that.
Okay, we'll take it later on. Sir, the other question is, we have increased our touch points, okay, and from 65,000 to 240,000, okay, and a lot of addition has happened places where the orders are not regular, okay, as you mentioned earlier. So how has your distribution network also evolved to cater to the new changes which have happened, okay? And
yes. So yeah. Okay. First, let me answer this. So definitely one of the challenges which we are facing is because our network or our distributors are mainly in the stationary category. So they are used to servicing the stationary outlets and not the other than stationary outlets. So this is one challenge which we are facing. So what we are trying to do is, identifying distributors who have, equal reach of the FMCG outlet as well. So this is the kind of a transition period going for us that, and which will take a long time. It's not very easy to, change the distributor profile. So those distributors who are not willing to service the non-stationary outlets will be gradually phased out, and new set of distributors will come in. So this is But as I said, it's a long drawn process, and
one
this
thing.
is how it's going to evolve. Yes.
Okay. And one thing from FY20 to
This is
today, last question, okay. From FY20 till today, how much would our sales force would have increased?
The sales force is more or less same. As I mentioned in my earlier calls, that we have small team of telecallers. So, the low throughput outlets are being serviced by these telecallers. So we try to keep the number of field staff same, but definitely it is going to increase, gradually, but not very radically.
Okay. Thank you. Thank you for your patience and replying. Yeah.
Thank you, Manshu. Yeah.
Thank you. We have the next question from the line of Saket Mehrotra from Tusk Investments. Please go ahead.
Hi, am I audible?
Yes, please go ahead.
Yes. Hi, Saket.
Hi, sir. I heard that you were talking about a guidance of about 700 crore revenue by FY25. Is there any sort of interim guidance you set for FY24?
Not really. As I mentioned that, of course, we are looking at a CAGR of about 20 to 25%. So, that can be, taken as a guidance, but we've not given any, a number for FY24.
Okay. And the other thing...
We revised the guidance, from 650 to 700 crores for FY25.
Okay. And the other thing is, there was also mention of that the annual operating EBITDA margin, roughly, we are looking at about 14 odd %. So this quarter, I think we did about 15%. So is this like a one-off, or like do we expect this to normalize at 14?
It's not one-off. In this quarter we achieved 14.6% to be precise.
Okay.
But I like to admit that this quarter the polymer prices have been one of the lowest. So that has benefited us. And so currently, we can see some upward trend in the polymer prices. But having said that, because our product mix is improving, every month, so we can offset such price increases. So we should be able to maintain this, around 14%.
Okay. Thank you so much, and all the best.
Thank you. We have the next question from the line of Darshil Jhaveri from Crown Capital. Please go ahead.
Hello. Hi. Thank you so much for taking my question, and congratulations on a great set of results. My questions are once again limited to our EBITDA margin. So even if how much of an impact would our polymer prices would have happened in this quarter? Like, how much would be a differential? Because even last quarter we did above 12%. So what would be the difference that would be the drop in polymer prices that has helped us? Hello.
This is the operator management.
Hello.
Are you able to hear us? Participant, please stay connected.
Okay.
Just give us a moment. Ladies and gentlemen, please stay connected. We are reconnecting the management. Excuse me, this is the operator. We have the line for the management now reconnected. Thank you.
Yes, I was talking to Mr. Jhaveri. Yes.
Yeah. Hi, sir. Thank you so much. And I just wanted to first congratulate on a great set of results. One of my question is also very related to a previous participant's question, that our margin, we've already done about 14.6%, and so the margin with higher, scale, economy of scale seems a bit conservative. So how much did the polymer price, impacted us? Like, is that because even last quarter we did about 12%. So, how much, differential could that be right now?
Yeah. So I think the contribution of polymer prices in this would be maybe about 100 basis points, maybe 100 basis or 150 basis points.
Okay. Sorry.
But of course, yeah.
So 9 months is 12.7%.
Yeah, 9 months is 12.7% EBITDA, and of course, this quarter has been more than 14.5.
Diesel element is also there.
Yeah. But of course, with scale, definitely we should be able to maintain or actually improve upon this. But we just like to be a little conservative because maybe in some quarter there can be higher ad spend, if we are launching a new product. So for those factors, we just trying to, keep it a little conservative.
Okay, sir. So that's fair enough. And so my other question was regarding our stationery business. So I think currently about 10% of our revenue comes from our stationery, non-writing segment. So would this enjoy a similar margin profile as a writing, or would there be a difference?
Definitely not. The gross margins would be much lower in the stationery segment since these are outsourced. Yeah, but I think we should be able to at least improve our EBITDA with overall increase in the revenue. So that's the idea.
Okay, sir. So currently, how much EBITDA would non-stationery products be doing?
So
stationery products. Sorry.
Yeah. So. Yeah, but actually I'm not very sure about that because there are different categories have different margins. So I'm not very handy with that.
Okay.
Yeah, definitely lower. Yeah.
Okay, sir. And our target would be to get this to rupee 100, Delhi revenue to get to rupee 100 crores by, we can expect it by FY25, or, how would that? So our
That is by 26, yeah.
Okay, that is by 26. Okay, sir. I think that helps me. Thank you so much, and all the best for the upcoming quarter. Thank you.
Thank you, Mr. Javed.
Thank you. We have the next question from the line of Hiten Boricha from Joindre Capital. Please go ahead.
Hello.
Please go ahead, sir.
Yeah. Thank you for the opportunity. So I have a couple of questions. I'm tracking your company for the first time. So the first question is on the Delhi brand, which you told you are looking for like 100 crore revenues in next 3-4 years, right? So just wanted.
This is the operator. So there is some disturbance from the background. Please could you?
Hello.
Yeah.
Is it clear now?
Your audio is clear. There's disturbance from your background, sir.
Hello. Yeah. Is it okay, ma'am, now?
Sir, if you could ask the person to stop.
Somebody's having conversation.
Yeah. They are gone now. So extremely sorry for that, sir. Is it okay?
Yes. Thank you.
Yeah. So sorry for that, sir. So my question was on the Delhi brand which we have started. So just wanted to understand, we are looking for the new products. You mentioned calculator, pencils, crayons, etc. So all these brands all these products which we are going to manufacture, everything will be manufactured, everything will be outsourced, right?
Yes. So yeah, currently under Delhi brand, we are already doing calculators, scissors, desk organizers, and all these are imported from Delhi. So, but definitely when we get into products like crayons, which are very close category to the writing. Those products we may not launch under Delhi, which we may like to produce by ourselves or outsource locally under Linc brand.
Yet, you are talking about crayons, right?
Yeah, I'm talking about crayons. Yeah.
Okay, sir. Okay. Yes. And sir, you mentioned we are doubling our capacity to 20 lakhs per pens, which is, so currently 10 lakhs pens. What's the utilization here?
The utilization, of course, varies from month to month, but on average, you can say we are able to utilize more than 80%.
More than 80%. Is this a peak utilization, or we can go up to 100 or maybe more than 105?
We are actually utilizing 100% in the peak month, but in the lean months, it is less than even 80%. So on average, as I said, that it would be about 80%. So in the high season months, we are struggling with the supplies.
Okay. Yeah. Yeah. Sir, and only one last question. Say, you mentioned we are looking to grow at around 20 to 25% for next 2-3 years, and we have consistently doing 100 and 120, 125 crore sales from last 2 quarters. So is it you are guiding conservatively this year, or maybe if we are going to do another 120 crores kind of sales in Q4, so our sales should grow more than 32%, right? So is it you are guiding conservatively, or there's a seasonal type of sales in our business?
No, actually, frankly speaking, we like to grow at a much faster, pace, but we realize that it's not. Our plans are always more than 25% is the target. The internal target. But we realize that whatever you do in this category to grow more than 20-25% is not that easy. So that is the guidance we have kept, but we are always internally aiming at a much higher, growth rate.
Okay, just a follow-up on this, sir. So we have already passed 1 month for this quarter. So can we easily do around 100 crore sales in Q4 also? If you can give some sort of understanding how this quarter is panning out.
This is the best quarter.
Actually, traditionally Q4 is the best quarter for us. And so if we have done already 125 crores in the last 2 quarters, ideally it should be more than that.
Oh. Okay, sir.
100 is no. 100 is. It's it should be minimum 125 crores. So this is what I need to.
Okay, so maximum revenue apart come from Q4. Okay, understood, sir. Understood. Take.
Yeah.
Okay, sir. Thank you for the opportunity. I'll get back in the queue.
Certainly. Yeah. Okay.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of Devesh Shrimali from DS Investment. Please go ahead.
Hi, good afternoon. Congratulations for a good set of numbers. Most of my questions have been answered. I just wanted a little quantitative from your side that for the 20 to 25% growth, and like you said, internally you tried to get a higher number, what would be the risk or deterrent that you think may sort of create an obstacle? It's in some risk that you see out of these guidance. It's just qualitative way of understanding.
If I've understood your question correctly, the risk could be that we built up capacity as per our projections, internal projections, and if we are not able to meet that, we may land up with some excess inventory and some excess capacity So that is the only risk, which we foresee. Other than that, there is not much risk.
Okay. Maybe I'm sorry, Mike. I think I wasn't clear in the question. So what I'm trying to understand is that part one is that when we do the planning of 20 to 25% growth, what are the key drivers that we sort of identify that, whether it's geography expansion, whether it's a category expansion and things like that? And in terms of each of those drivers, so what are the risks that you see if you can call them out, right?
Okay. So the first, of course, is the premiumization. So as you would see that, traditionally, majority of our revenue used to come from, below a 5 rupees, I would say 5 rupee pen. But today our, revenue from 10 rupees and above is almost 60%. So which used to be less than 20%, a few years back. So that is I think that is a major driver in, for the value revenue growth. And of course, apart from that, as we've been talking about increasing the touch points, even geographical, expansion. So, traditionally we've been, Eastern region centric, company, but our contributions in the Western and Southern zones have increased, substantially in last 2 years, I would say, with introduction of Pentonic. So we have good opportunities to grow in southern markets and the western markets, and of course exports. So these three, I would say.
Sure. No, that's quite helpful. Thank you. And just last bit on the export, which are the countries that primarily cater to, and how do you see that over the next few years?
So, of course, we actually export to more than 40 countries across the world. So we have customers even in the US, we have customers in the Japan, we have customers in Southeast Asia, Africa is our, I would say, major, one of the major markets, and some countries in the Middle East. So we are almost all over, even Russia for that matter. So we are almost all over, and we are trying to penetrate deeper into these existing markets, apart from opening newer markets. So this is about the exports.
Great. And would you say that export margins are at least equivalent to what we get in the market, or do you think they will be slightly lower?
Actually, for us, fortunately, export margins are higher than the domestic margins.
Oh, great. So that means that the export mix of overall revenue as it grows, it should help us in the overall margin as well.
Yeah, right. So this is how we like to hedge the polymer price fluctuations. As we increase the export contribution, we can take care of such, fluctuations.
Got it. Thanks a lot, and wish you all the best.
Thank you. Thank you so much. Yeah.
Thank you. Ladies and gentlemen, if you have a question, you may enter star and 1. We have the next question from the line of Yash Bajaj from Lucky Investment Managers. Please go ahead.
Hi, good evening, sir. Congratulations on a great set of numbers. Sir, I had a question regarding the change in strategy which we made by consulting Vector Group. So I just wanted to understand what were the key observations and what was something which we changed on, and we could tap on the right consumer behaviors.
Actually, Yash, there has been no change in the strategy. when we roped in Vector, the purpose was to, we called it RREP, Reach and Range Expansion Project. So we are continuing to work on that, even though the speed of expanding reach is a little moderate currently, but I think that is the only way to achieve our revenue growth objectives. So there is no change actually.
So suppose before Vector helped us in or whatever gave us consultation. So before that, we were targeting only stationery shops as compared to what we are doing right now in terms of kirana and fun shops.
Yeah, actually, before Vector came on board, frankly, we did not have much of automation or digitalization which we have today. So we have a great visibility of how many stationery outlets we are directly covering. So that is the added benefit which happened after Vector came on board. And before Vector came, we were trying to sell to the existing set of retailers and trying to give them a QPS, I mean the quantity purchase scheme. So I think we were not really doing right thing. So we were expecting that the same retailers would give us increased revenue, which was actually not happening. So that was the reason that we were at a kind of a loss that we are not able to grow, and we roped in Vector and yes. So it's not that only we are expanding our reach into kirana stores, but we are also expanding our reach into untapped stationery outlets, across the country.
Okay. And if you could throw some light in terms of, or just to try to help us understand what is the distribution like right now in terms of how does it function basically once you, is it on an order basis that once they order is that time do we deliver the products to them, or it's on a month-on-month or a quarter-on-quarter basis? How is it like right now?
So today we have this we call it a buffer penetration replenishment. So currently we have this system that from our channel partner, let's say if a channel partner sells one carton of a particular product, it automatically triggers into our system, and one carton is gone into production. So it is basically rather than a forecast-based supply chain, it is a consumption-based supply chain.
Okay.
So this is how we are currently operating. I think which most of the companies are now trying to follow in other industries. I'm not sure about our industry, but in many other industries, this is how it is being followed.
Okay, got it, sir. And just last question, sir. So all the 240 touch points are on this portal which you mentioned, or how is it like right now, or where are we?
No, so as I mentioned, that we are not billing to these 240,000 outlets every month. So some of the retailers, they are buying once in 3 months. So there are many such outlets, like those non-stationary outlets. So their frequency of buying is much lesser compared to the stationary outlets.
Okay, so what is...
This is the operator. I'm sorry to interrupt, sir. We have participants waiting.
Sure.
Thank you. Ladies and gentlemen, we will take the last 2 questions from the line of Zakir Nasir from an individual investor. Please go ahead.
Hello, can you hear me?
Yes. Hi, Zaki. Yeah.
Deepak bhai, congratulations to you and Team Linc for such a healthy, wonderful set of numbers, sir. And I think there's a lot of optimism in your voice when you say that Q4 would be the best in the current year. Deepak, Dujari ji has said that 25 you're looking at 700 crores, sir, with EBITDA of 14%. Now, how will this look, sir? How much would be Pentonic? How much would be your Delhi? And how much would be Uniball or Mitsubishi Pencil? That is my first question, sir. Another question is, I see a lot of visibility on the Mitsubishi JV where a lot of more ads for Uniball are being seen. Do you plan anything like that for your Delhi tie-up? How would the Delhi tie-up look going ahead, sir? Would that be a little more formalized and stuff like that, sir? Thank you.
Okay. So, about the first question, Pentonic, we estimate that it should be about 35% contribution in our overall revenues by FY25, and that I'm saying at least. So it should be more than that, because that is going to drive our GPM. And Delhi contribution should be anything between 10 to 15%, and similarly Uniball, 10 to 15%. So and as we go forward, we will be able to give more accurate numbers, but this is the range which we are expecting.
Okay, this is about it. And your relationship with Delhi, sir, because I think that is also a major company. So, I mean, how would they want to formalize the tie-up with Linc?
Yeah, so actually we are, of course, always we are talking, even with Delhi, even with Uniball, we are talking of much more than what we are currently doing. But, it takes a lot of time to, make decisions. So right now we are good with this increasing the market share of the categories which we are handling from Delhi and Uni. And coming to your next question about the brand visibility of Uniball and even Pentonic, you must have seen.
Pentonic is visible everywhere. Uniball is little more visible, but what about Delhi, sir? I mean,
even Delhi, we have currently print campaigns going on, particularly in the northern region, where in several publications you can see Delhi ad also, apart from Linc and Pentonic.
Thanks a lot, Deepak bhai, and best wishes for the year. Thank you.
Thank you, Zakir bhai. Yeah, thank you.
Thank you. Ladies and gentlemen, we will take the last question from the line of Ashok Shah from LFC Securities. Please go ahead.
Thanks for taking my question. Sir, first of all, can you just give some idea why we are expanding immediately after starting a first plant and again we are expanding and increasing the capacity?
Sorry, come again.
No, we are expanding our production capacity at Gujarat plant, I think.
Right.
So what's the reason? Because we just started after many years, I think 40 years, we started a plant in near Western India. So because we are basically in a low price area company. We are basically in Eastern India working always, where it's a very much price sensitive market. But we entered Western India first time with the production capacity, and we are again expanding it.
So Ashok bhai, we are no more Eastern India brand. We are a national brand, and we are not only national, we are an international brand. Our products are available in 40 countries. So, and to meet the increasing demand, we have to expand our capacity. And so whether it is in Gujarat or in Bengal, it doesn't matter. We have to increase our capacity to meet our growth objectives.
So what was the capacity utilization at our Western India plant?
So as I mentioned earlier to one of the participants that we are on average it's about 80%, but in the peak season months we are short of supply. It's actually 100% capacity.
Okay, so what will be this increasing capacity in expansion? It will double or it will be more than double?
It will be double as per the projection in 2 years time.
It will be done in a modular way. As the demand picks up, we will keep on adding the capacity.
Yeah, so it will be done phase-wise. It's not that in one shot we will double the capacity. So we will do it very prudently.
Okay, sir, can you just guide me that if we produce the 5 rupees pen and if we produce the 10 rupees pen or the 20 rupees pen, then what's the production cost besides raw material?
Well, we are no more producing 5 rupee pens, so I cannot say about that, but we are now in the 10 rupee plus price segment. So, as you know that the GTM is, more than 40% in our pentonic range, which is similar in the 10 rupee and 20 rupee.
So as I understand, cost to produce a pen of 5 rupees value or the 10 rupees or the 30 rupees value, it's the same.
Yes, similar. Actually, yes, 5 rupee would be, the cost would be a little higher in terms of percentage. So, but if it is 10 rupees then 20 rupees, it is in the range of that, as I said, the GPM is 40%. And as we go up, yeah, maybe it may be slightly better.
So can you just guide me, what is the percentage-wise sale happening from the Western India or the North India and Eastern India, which is a price-sensitive market?
So yes, I can tell you that exactly. I can tell you that our contribution from Eastern India, which used to be our dominant market traditionally, so currently the contribution from East and North, which used to be our large market, is about 65%, which used to be more than 70% actually. So there has been increase in the share from western and southern regions. So it used to be less than 30%, which is currently more than 36%.
So does it mean that we are able to sell a premium product in Western India more than in Eastern India?
Frankly speaking, we are not really in very premium products. We are in the 10 rupee, 20 rupee price points, and they are actually sellable everywhere, whether it is Eastern India or Western or South.
I am talking about the percentage-wise sales.
Percentage-wise, more or less for us, it is more or less, same, we are selling equal number of pentonic in the, I would say in each and every region. But yes, you are right that traditionally Eastern region is, low price point market, but we are no more, focusing on that low price point. So there are regional players and unorganized players who are, serving that price segment.
Okay. Sir, along with the new production capacity and everything, I think as I have surveyed Linc as a brand in Bombay city, our distribution facility is very weak. I think as per the shopkeeper, small shop or this stationery shop, supply or the salesman is not reaching on regular basis. Or there is no touch point or what is happening, I don't know. But are we planning to increase and approach maximum touch point in a premium segment or in Bombay city?
Ashok bhai, thank you for your feedback, and I'm going to pull up our sales manager in Bombay, because Bombay is our one of the key markets and focus markets. And actually, I'm guaranteeing to people that, in every stationery shop, you can find a Linc or a Pentonic. So if there is still a gap, I need to pull up our sales team, but I think that there may be some gaps, definitely, because general trade is a very large market, and there may be that our team is maybe missing some outlet. But
so do we consider our company as a FMCG company, because we are a brand sensitive market in brand sensitive?
I consider our company as a FMCG company, because because a pen is used within a week or 10 days. So whereas if you buy a bottle of oil, it lasts for a month. So pen is typically a FMCG product, and it is distributed like an FMCG product.
So simultaneously, supply and the distribution will be improved like FMCG company.
Yes. We like to be Colgate of pen.
Okay. Sir, there is one suggestion from my side, as I am an investor since last more than 10 years. So my suggestion is, you are sending every year one set of pens. So better send some information about the company along with this set of pens. Because as an investor, I do not get anything from your side in physical format. Neither an annual report or not any communication like a half-yearly result, or nothing is been received. Physical format. I am talking about physical form, not about email. When you send some pen or something like that, if it is done for one investor meet is held in a Bombay city on a personal level or at our Bombay office, then it will be much better, because being a Kolkata-based company, it's very difficult to track the company on regular basis.
Okay, Ashok bhai, first of all, thank you for being investor for last 10 years. And definitely, we will send you, because after the COVID, we started sending online the annual report, but we also print some annual reports in physical form. And I've already asked Mr. Dujari to send you, specially to you, the physical annual report.
And try to hold one meeting at least once a year, physical meeting in Bombay city at least.
Okay, so that suggestion is well taken, and maybe someday we can have AGM, one of the AGMs in Bombay.
No, not AGM, but at least one plant visit of Western India.
Okay, we will definitely do it, yes.
Okay, sir. Thank you, sir. Thanks for taking my question. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Sanjeev Sancheti for the closing remarks. Please go ahead, sir.
Thank you. Thank you, Naveen. Thank you, everybody, for joining this call. If you have any further questions, please feel free to reach Mr. Pujari and the investor relations team. Stay safe, stay happy. Thanks a lot, and have a great weekend. Thank you.
Thank you, ladies and gentlemen. On behalf of SKP Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.